Hey harvesters, and welcome to the channel. My name is Matt. In today's video, I'm going to be going over the trades I execute for June 4th. We're going to be talking about the covered calls, the cash secured puts, and everything in between when it comes to running these options strategies. Then we're going to scoop over to an Excel spreadsheet. We're going to talk about the tactical level decisions I made choosing strike prices and my thought process for choosing specific options. Then we're going to head over to another spreadsheet where we're going to talk about the holistic overview of the last 37 trading days. I adopted this strategy April 11th, and we're going to see how it's progressed thus far. Then we're going to rip it over back to Robinhood. Then I'm going to talk about what I plan on doing for tomorrow and some of the trades I plan on executing. So if you're interested, don't hesitate to subscribe, press that like button, leave some comments, and let's get this ball rolling. For anybody that is a new viewer, this Robinhood account and this YouTube channel is strictly for income generation. This is not a buy and hold long-term channel. This isn't a, hey, I'm going to watch my dividends grow over year. We're not going to be waiting years to make income. We're going to be making the income now. So therefore, we're going to be running options daily, weekly, monthly, so that we can produce that income. Because ideally, I want to use this money immediately to either enhance my life, pay some bills, food bills, grocery bills, gas bills, mortgage payment, maybe truck payment. I want to be able to use this money now so I can enhance my life. Or if I reinvest all of the money, then maybe 4 or 5 years from now, I make enough money trading options where I don't need to use a W-2 income. So that's kind of the goal long term, and we'll see if that plays out. So follow my journey to see if that is a reality. But for anyone that is a returning subscriber, the first thing I like to show on my channel is my account value, and that's more so a sign of transparency. I'm not a spreadsheet warrior. I'm not just talking theoreticals like some other YouTubers out there. Account is valued at $159,770.97. Let's head over to the Excel spreadsheet and talk about what I did for June 4th. All right, guys, the first thing I want to talk about for June 4th is my covered calls that I had to roll on Monday. If you guys remember what I did on Monday, I chose a strike price at the 590, and then the SPY actually went above my cost, or the SPY went above my strike price. And because I bought my SPY shares at this 593.13, I did not want to realize a $313 loss per contract. So I had 2 contracts out at one time. So I didn't want to realize $626 loss because I chose a strike price below my cost basis. So therefore, I rolled my option. So I rolled it 2 days to the right. So I rolled it Monday, and then today, Wednesday, it expires. And then I chose a new strike price at the 594. So because now I am positive or above my cost basis, I'm cool with my SPY shares getting assigned away. So I made about $87 of appreciation per contract. So that's what I think $174. So that was a win there. And then from just rolling the option, I think I made about $8 per contract on top of that. So not necessarily too great, but in a day, I still was up about $174 of appreciation. So I'll take that any day of the week. And then when the market opens back on June 5th, I plan on just buying another 100 or 100, maybe 200 shares of SPY. I might buy 100 shares of QQQ instead. Let me know what you guys think in the comment section. I think the premium is going to be a little bit higher. And I definitely think the AI push is pushing the QQQ a little bit higher, faster than the SPY. Just food for thought. I don't know. I'm going to observe the market and make a decision about that. And then, so just to kind of understand for some of the new viewers what a covered call is, to run a covered call, you need 100 shares of an underlying. 100 shares is one options contract. And since I had 200 shares of SPY, I was able to run 2 covered call contracts. And that's what I was talking about here. Now let's talk about cash secured puts. Before I talk about the nitty gritty of what I did, let's talk about what a cash secured put is. Cash secured put is an investor is going to pay you an upfront premium so that they can offload their shares at a specific price or specific strike price. The only thing you need to bring as an investor is collateral to buy 100 shares of that underlying. So that collateral could either be margin or it could be your cash. So now that we have that foundation, for June 4th, I ran 2 cash secured puts. I chose I think that's wrong. I had to make a minor adjustment. I chose the 525 strike price for both of my cash secured puts. And at the end of the trading day, the QQQ was at the 528. And the way that cash secured puts work is the market has to go down to 525 for me to get these shares assigned. So for cash secured put, you're actually buying the shares from an investor versus a covered call, you are selling your shares that you own. And for me to get my SPY shares assigned, the SPY has to be at 594 or higher. And because the market closed at this 595.90, it was higher than 594. Therefore, that's why my SPY contracts were assigned away from me. So I sold my shares of SPY. So end of the trading day, I made $268 of appreciation and premium. If we took away the appreciation I made today, I would have had a really light day of only $94 of premium. But end of the day, everything happens for a reason. I was able to realize that gain for selling my SPY shares. So life is good. We had a $268 day, and I will take that every single day. So I'm just going to talk about a little bit of how I do my investing. So all of the money I make from premiums, I reinvest it back into the SPY. So I just got caught up on buying more shares of SPY. So I just put another $1,500 order to buy more shares. And then all of the money I make from appreciation, I'm just going to leave in my account as either cash or buying power so that I can continue running these options. So theoretically, as the market's moving up, the account value is growing at the same time. So I'm able to use the buying power and continue running the same amount of options contracts, because theoretically, if I would have kept buying more shares of SPY or QQQ, then eventually my buying power would slowly diminish because I don't have the cash to then run some of these trades. That's kind of food for thought. Let's head over to the other side of the spreadsheet and talk about how trading these options, these safe options, have been performing over the last 37 trading days. All right, guys, we are at this side of this spreadsheet, and this is my favorite thing to talk about. I love tracking things. I love looking at the metrics and then making decisions based off of the metrics. So when I first started this back in April 11th, the account was valued at $86,312.66. But then later down about a month later, I sold the primary residence I was living in, and I happened to have a lot of cash at the end of it. So then I threw about $60,000 into this account, and then the number I'm going to base most of my calculations off of is now this $146,312.66. However, from the point of this 86,000 all the way up until May 20th, before I threw that money from selling that house, we actually had a 12.79% gain. But then once we did that 60K transfer, the gain definitely diluted a little bit from 12.79 down to this 9.20. So, but now that I have more money in the account, I'm going to produce more money. And then is it going to be as much as 12.79? I definitely think we'll get up there once we get this momentum going, because it's only been a couple of weeks and a couple of trading days since I've made that 60K transfer. But yep, since April 11th, we're up 9.20%. And then from the last 37 trading days, I made $11,009.63 of premium and appreciation gain. So that is fantastic. This is realized, right? I have some appreciation gain because I own a couple, like 15 shares of SPY, but this is realized gain, either premium and appreciation. So yeah. Moving on to the trade win percentage, I'm winning 97.3% of my trades. I have 36 winning days, 1 red day. And like I mentioned, we've only traded for the last 37 days. The average premium I'm making per day is about $297.56. The weekly premium is $1,376.20. And the average monthly premium is about $3,669.88. All right, guys, in the yellow here, I came up with some data based off of the statistics and metrics I am tracking. And so what I did here is I multiplied the average weekly premium by 52 to get this $71,562.60. I definitely think this number might be a little bit too optimistic. However, I think a more safer assessment would be making about $1,000 a week for my account value. I think that's a safe number and very attainable each week. And the market since April 11th has kind of skyrocketed up. So therefore, I definitely think some of the premiums might be a little bit lower coming up because the implied volatility is going to be a little bit lower. But if we look at that as an average yearly percentage, it's 49%. And the goal I came up with when I started this back in April for this first, from April all the way to the end of 2025 was to make about $29,740. And because we are already at 11,000, we only need 18,730 more to go. So we are well on our way to to get there. Let's head over to the weekly trackers. Over the last 37 trading days, we had 8 total weeks. 7 of those weeks were green weeks, and then 1 week was a red week. And that one red week happened to be because I had one bad trading day, which means I chose a strike price below my cost basis. And then when I rolled the option out of the money, I didn't choose a strike price high enough because I was maintaining my greed threshold. So therefore, I got punished big time for it. But then we see here that was on April 22nd. And basically from April 22nd, I have not had a single red day. And I'm hoping that maintains forever. That also might be optimistic. But as long as I stay true to my fundamentals, I shouldn't have a red day. If I invest in good investments, I don't choose strike price below my cost basis, and I'm just patient in the market. I take what the market's giving me. I'm not forcing anything. I shouldn't realize a loss. Cool. So for the week we are currently in, we're up to about $647 a premium. And for the monthly tracker, we haven't even had one full week of trading in June. And so it's also $647. And we already talked about the yearly tracker. We're at $11,009.63. Cool. Now that we talked about this stuff, guys, I definitely love running these options myself. It gives me the flexibility to make a premium on a daily basis. You don't have to wait once a week, once a month, once a quarter for money to come in. You can kind of go out, make it, and then you choose investments you want to invest in. It's kind of cool. And my principles for this trading is invest into good stocks. If you can afford to run options against QQQ or SPY, I highly recommend it. And I recommend doing it daily because if you run options daily, you can kind of adjust to the market conditions. If it goes up, you can kind of adjust your strike prices higher. Market goes down, you can choose slower strike prices and vice versa. But if you don't have an account like mine, you still can run options against an actual individual holding. I highly recommend nvdy, Amazon, Tesla, Oracle, any type of like AI tech cloud stock. That is going to do pretty good moving forward the next few years because that's the big hotness right now. And regardless of what people say, if you don't have that kind of money, anything between $10,000 and $20,000, you can choose an individual holding, run weeklies, and do the same strategy. Yeah, guys, let's head over to Robinhood. Let's talk about what I plan on doing for tomorrow. Okie dokie, guys, we are back at Robinhood, and let's talk about what I plan on doing for tomorrow, June 5th. So ideally, I'm probably going to buy 100 shares of SPY and then 100 shares of QQQ. And then I'm probably going to run 2 cash secured puts on QQQ. And that's kind of what I plan on doing for tomorrow. If I can make about $50 per contract and it will have like a $200 premium day, that'd be pretty solid. All right, let's head over to SPY and take a look what we're dealing with here. Head over to Trade SPY Options. You guys are going to hear me beat the dead horse with this one. Do not do buy call. You're just going to lose money. 95% of investors, whenever they do buy call options, they're going to lose money. So don't do it. So we're going to make sure we choose a strike or a expiration date of June 5th. I run 0 days to expiry or expiration, whatever you want to call it. S&P 500 trading at this 595.64. And when the market opens, I'm just going to scoop up 100 shares. And then I'm probably going to run an option maybe $3 away from the money. Might choose this 598. So take a look at what the delta is. So the delta is about 3.1. So the way delta works, it's like the likelihood of this contract executing. So if it's a 0.31, that means there's like a 31% chance that this is going to execute. The closer it is to the 1, that means the higher the likelihood. And anything like 1 point something is you're 100-something% likely. But to run a covered call, we're going to do sell call, and that should be the same price, this 89. So yeah, let's envision that we choose this 598 strike price. So kind of what I mentioned earlier in the previous spreadsheet, the way this works, investors are going to pay you an upfront premium for you to sell your shares at this 598. And 2 scenarios that happen out of this. The contract expires worthless, so this SPY trading at this 595 does not appreciate to 598 or higher. You basically keep that upfront premium. You keep your shares. You rinse and repeat this the next day. Life is good. Scenario number 2, SPY appreciates at 598 or higher. Therefore, at the end of the trading day or whenever your contract expires, you are going to get these assigned if the SPY is higher than 598. And then there's two drawbacks for running covered calls. The first one being that if the market blows a little bit higher than what your strike price is, you lose potential gain. So kind of what happened to me today is I had the 594 strike price, but then the market went up to 595.61. So I theoretically wasn't able to realize another $160 of appreciation. However, I'm cool with that appreciation I got from when I bought in at and the premium I made over the last couple of days holding and trading that 594 strike price. And the other thing that can happen is, say we buy this SPY at this 595.61 and the market kind of tanks a little bit. We're going to be trading a bad premium if we don't want to choose a strike price below our cost basis. Say it drops down to 585. So we theoretically would have lost about $1,000 in depreciation. You don't realize this until you sell. So if you just wait for the market to go back up and wait for the premiums to go higher, that's one case scenario. Or if you get greedy like me, sometimes I choose a strike price a little bit closer to the 585. If the market were to go down, I might choose something like 588 or 589 so I can make a little bit of premium and not necessarily risk getting my shares assigned. But I think somebody's asked in the comment section, how do you actually run a roll? So let's head over to IWM because I have an options there, and then we'll kind of discuss the scenario. But to finish this off, if you happen to get caught with your pants down and then the market shot up once you're choosing strike prices closer to what it depreciated to, but then you bought in at this 595, you can just roll the option. And let's talk about the rolling option. So I have a covered call for IWM that expires on Friday. And there's a button here that you can roll this position. So the way this works is at the current market, you have to buy to close. So that means you are buying back the contract that I'm selling that I've already sold and got an upfront premium. So I have to pay out of pocket $149 to buy back the contract that I was selling. So theoretically, you don't need to roll the option to do this. You can do this separately without the roll button, but this makes it a little bit more convenient. So ideally, now I have to pay the investor $149 for that contract. And then now I can choose a new strike price. And ideally, if you're caught off guard and the market's red, it doesn't hurt to choose an expiration date a little bit further away so that the premiums are going to be higher, because the closer you choose the premiums, the less they're going to be. So the more likelihood you are of not making your money back. So if we choose maybe, 2 days away and we choose like the 209 strike price, like 2 days away at this 205, theoretically, you would make about $56 of additional premium. So you make a net credit. So therefore, whenever you roll your options, that's one thing you can do. You can choose an expiration date further away, and then you can choose a different strike price depending on whatever your cost basis was. My cost basis was 208.51. So as long as I choose something higher than 208.51, so it'd be like 209, life would be fine. So it's kind of how a roll works. Let me know if that explains it or you need a little bit more detail. Yeah, you would have made about $56 extra rolling this contract by just pushing out the expiration date. Cool. Now let's head over to QQQ and talk about cash secured puts. As far as the covered calls, let's do covered calls first. Go to trade QQQ options, sell call, and let's talk about the QQQ. So ideally, when the market opens, I'd buy 100 shares at this 528.16, and then I'll probably choose a strike price at this 530, maybe this 531, delta 32. Yeah, I might choose a strike price of this 532. Rack in $103 of premium. Life would be good. So it's the exact same thing as the SPY covered call, but let's talk about the cash secured put. So again, we're doing an expiration date of June 5th. We're doing a 0 days to expiration. So QQQ trading at this 528. Let's look at something $5 away. So let's look at 523, $46 of premium. About a 15% chance of it executing. Maybe let's choose this 525. Let's choose a 525 strike price again. Let's imagine that when the market opens tomorrow, everything stays exactly the same as we're seeing right now. I'm going to choose this 525 strike price. Let's talk about it. Investor is going to pay me an upfront premium of $76 so that I can buy that investor shares at the 525 if the market were to go down. And the way it works, two different scenarios. Expires worthless, so investor pays you upfront premium. You have to bring enough collateral to buy 100 shares of the underlying, and to buy 100 shares of QQQ at this 525, you need $52,500. Cool. With that being said, like I said, the first scenario expires worthless. The QQQ is trading at this 528 and it just stays up there, never goes below 525 or lower. You keep that upfront premium, and then your collateral gets given back to you at the end of the trading day, and then you can rinse and repeat this tomorrow. Now let's say the market does go down to 525 and you are assigned these 100 shares of QQQ. Once you get these shares assigned of QQQ, then you can just turn around and sell them at the money. Ideally for me, because I'm running a cash secured put, usually it's on margin, I'm going to sell at the money so that I can offload these shares, maximize premium, and then offload that margin. All right, now let's talk about the negative things of a cash secured put. Kind of like covered calls, the market might go way below your cost basis, or when you were assigned the cash secured put. Let's say it goes down to 515. I just like using simple numbers of like 1,000 away. And then now we have that same conundrum where the market's trading at 515, but then we bought in at this 525. We're going to be trading at bad premium until the market goes up, or we potentially risk getting assignment because we want to wheel and deal premium closer to this lower strike price. And then if we choose lower strike prices, then if the market shoots back up, then we have to roll it. And that's a possible outcome. However, it's not a bad thing, right? Like I just showed you for rolling the options, it's not really scary. You're going to buy in at a certain price, but then once you choose the price to then resell your contracts at, just choose a date that's a little further away, and then choose a strike price that's at your dollar cost average or higher, and then you're not going to lose money. So it's nothing to fear. Yeah, you might lose getting money for a certain period of time, like 3 days, 4 days a week, maybe 2 weeks, depending on how bad the market was. But as long as you don't lose money, it's a win in my book. Yeah, guys, that wraps up the video. Let me know what you think in the comment section, and let me know if you want me to continue adding the rolling strategizing into the videos. Yeah, guys, that's it. Matt out. I will see you in the next one.